Thank you, everyone, for joining us. We have just an interesting topic tonight that maybe a lot of folks aren't really aware of, or something that we all can learn more about. Whether it's fortunately or unfortunately that we have to learn about tariffs. It is something that is affecting us right now in this day and age, in our both our economic, our political climate. Really, a large swath of the U.S. population are feeling some of the effects of inflation, of tariffs, ultimately our taxes as well. So we thought we'd combine all that together in one kind of big presentation here this evening. So we'll go ahead and get started and dive in. If you do have any questions during the webinar, please go ahead and submit those. We will cover those at the very end, unless it's something that's important to the topic at hand, and then we'll just go ahead and discuss it as well. So hopefully that should work there. All right. Sorry, I'm just getting a message that I was muted, but I don't think that is the case. So again, please comment if there's any issues with the audio, and we'll make sure we get those addressed. So, all right. First of all, just got to lead off with one of those fun disclosures. This is meant for educational purposes only. Should not be considered tax, legal, and investment advice. Please consult with your qualified financial planner, attorney, or tax advisor if you'd like to implement any of these topics here tonight. We are here to help if you are looking for anyone to help on the financial planning side, and we will discuss that as well. But please don't take that as advice in your specific situation. All right, getting started here. So, tariffs. What are tariffs and why do they matter? Well, tariffs really do affect everything when it comes to our household budgets, things that are affecting. Oh, I realized I just didn't start my video here. All right, sorry about that, everyone. Hopefully now you can see me. Again, they do affect pretty much everything around us. So whether that is our household budgets, hidden taxes, just kind of that ripple effect when it comes to just everything around us. So we have global trade that is trickling down into really our personal finances. So it is quite a global trade system we have right now that is going on, and that is something that again we are just dealing with and the repercussions of that. So it is quite an interesting dynamic with how the tariffs kind of come down through all the way down to our personal finances here. All right, so understanding really what tariffs are. So, tariffs are, in all sense of the word, really just a hidden tax on those imported goods that we consume. So, as Americans, we consume, anything from our household goods to those things that, we like to spend money on for enjoyment, whether it's recreation or fun or things for family members, gifts, all those things that are really those hard gifts, those hard assets. Have seen some type of tariff. On average, in 2025, our U.S. rates are up between 18 to 27% since just the early part of the year. Really, actually, since April, since Trump announced Liberation Day. But overall, this is pretty much the highest we've seen since the early 1900s. So. Wouldn't consider it unprecedented, but definitely within the most recent history, we are seeing the effects of those tariffs come into play, and really not even the full effect of those. A lot of them haven't, fully played out yet within a month or quarter cycle. So. The consumer goods, again, those raw materials are really what's affected. Building materials as well. We saw a huge spike with goods with supply chain disruption back during COVID, and we're again kind of getting hit with a double whammy again here with raw materials. So building goods as well are being hit. Household goods, expenditures, whatnot. So. As far as the intention of it all, really this is intended to incentivize domestic production. So, think of it like the cure to the disease that you have. You are you know what the cure to that disease is, but unfortunately there are some side effects to get to that ultimate cure or to get to that better place. of healing, and really kind of we're in that phase right now where it's hurting a little bit, but eventually down the road it is going to help, and it will solve the problem, not just the symptoms. So that's really the phase that we are in right now, and we'll talk about how our U.S. policy is trying to fix that. All right. So, in terms of tariffs and the operational function of them, so they do increase cost. So there's no way around that. Whether it's manufacturers, retailers, if you have a tariff on something, that's basically you pay more for that. It doesn't matter where you pay a cost. If you pay a cost, it's a cost. And so that increases the amount of that particular product. So if you're a retailer, your wholesale price is more. Then when you go to sell that to the public, that's going to be a higher cost to the public because you're passing that on. So you may find a way to, cut a cost in another area. So maybe you're not passing on the full brunt of that cost, whether it's $1 or $5 per good or $100 per good. But you are still passing on a cost of sorts. So that's what causes that increase in that, final cost to the consumer. In terms of reducing the imports, it increases really what the price is here in the U.S. If you import something, and we'll talk about that here in just a minute, from the United Kingdom, but you're in the United Kingdom, that's not as much. So we're talking about kind of where that product is purchased, what what border, what ground you're purchasing on, whether that's foreign or domestic. But it does reduce those imports, and that's one of the reasons for it is to incentivize that production here, in domestic soil. Again, we talked about the indirect tax on the consumer as well. So, just a little visual here to kind of explain it more. Fairly straightforward in terms of the overall process, but so what are tariffs? They're that tax charge on goods coming into or out of a country. So, by the way, the U.S. is not the only one that has tariffs. Other countries do as well. So this will apply to any country that assesses a tariff. So more people buy those domestic goods. So, think of these again as, kind of your base level. Not really talking about services as much. So, if you have your lawn mowed, that, may end up going up because products are going to go up, but really this is talking about those domestic goods, those manufactured goods. So a lawn service or, your plumber, if it's just a, checkup or something like that, or, ongoing maintenance, might not see as big of an increase as that actual hard cost for a good. But again, to protect that country's economic interests, you're essentially investing in your U.S. or your own domestic soil, to help your domestic companies sell those goods here locally, and then increase that domestic employment. So helping out your local jobs, which helps out the local economy, protecting those interests, and really developing that industry here in the U.S. So, case in point here would be those, buying a pair of socks. So again, this is a domestic good. It's not something that's a service. It's something that you pay for. You can touch and feel it. Those U.S. socks, if you buy them here in the U.S., cost $3. Versus if you want to go ahead and buy those UK socks, they may look good, but they're going to be more costly. So even though the U.S. flag is better design than the UK, we're still going to pay more for those. So, you could argue which flag is better even in that case or the design, but you get the picture as far as why you're getting charged that, why those UK socks are more. So, just a quick visual there. Here. So, economic growth and the business impact. So just kind of to give, the kind of the broader landscape, more the economic front of things. So economically, U.S. GDP, which is our gross domestic product, in the second quarter, which ended on July 1st, was up 3%, aided by reduced imports. So we found a way to cut some of those imports already. So again, we are adapting the whole U.S. economy. The corporations that make up the U.S. business engine are finding ways to adapt. So whether it is going ahead and making those broad shifts, to maybe make some things domestically versus internationally. Some of those quick wins, we've seen companies go ahead and pivot and do that. So there are a lot of reports and a lot of I guess, outlook that says that, most investment or most U.S. companies, you will find it hard to shift every manufacturing process domestically, but we can still find ways to maybe, shun that brunt at least right now. So again, we are able to minimize some of that from the forefront, but that won't be the case forever. Again, that business investment did slow. Case in point is going to be, maybe putting an order in for, if you're a phone company, for a bunch of, semiconductor chips. And, if you normally get a big discount for buying those in bulk overseas, you're definitely going to go ahead and scale back on that. You're not going to put as much into that one product or that one type of accessory that you need to make that product. You're going to go ahead and you're going to, be a little more cautious with how you're spending, what you're spending. Look for ways to go ahead and, buy that product here in the U.S. Again, just comes back to that increased uncertainty, not knowing exactly which companies are going to have tariffs. This, by the way, will, I think, mitigate over time as we do find out, what the administration's policy is going to be long term on some of these things. We found that sometimes, it's kind of a hard stance up front, and then we kind of lessen that back a little bit. So that could be the case now. However, again, we are, a bit in these waters that we haven't really been into for quite some time. So it is still very uncertain. Just a few more stats here before we kind of get into maybe some things that we can do to go ahead and protect ourselves here. But just inflation overall, in June of 2025, we did see that rise. It's 2.6%. This is an average. So again, this is taking into account, housing and food and just overall cost of living. So we did see tariffs contribute anywhere from about 10 to about 15% of that 2.6%. So it is only about zero point 0.2 to 0.4% of the inflation number. So definitely not the bulk of it by any means, but it is still, contributing to those things, especially those household goods, things that we see kind of all the time on our budget. Those price tags are, first and forefront in the grocery stores. So it's something that we are, obviously seeing all the time. So it is contributing to those things. I would say it's fairly steady at this point, as opposed to seeing, kind of some of those big, those egg prices, when we had um, the shortage of eggs here, just at the beginning of this year. So again, not that drastic, so fairly smooth in terms of the overall rise. And hopefully we'll see that again start to drop as we find some of these trade deals come into place. And we'll talk about that here in a minute. The Fed is kind of cautious on those rate cuts right now as well. So, the cost of borrowing is still high with high inflation. So we do see, there is always the risk of what's called stagflation. If we do, see high inflation and maybe, slowing employment, things like that, those are economic factors that can lead to a slowdown in the overall economy. However, with GDP still continuing to go up, we are in still a good position when it comes to the overall economy. All right, so just a quick note on the optimal goal of tariffs. When it comes to tariffs, I don't think it's our administration's goal nor any other country's goal to, just tax, essentially our own citizens indirectly through the use of tariffs. So it can be used as a bargaining chip, and we've seen that come into place just recently here with the EU trade deal, where it is a kind of a catalyst to open the door to a trade discussion. So you don't want to, promote, bad relations between countries, but it is a way to kind of, open the eyes or wake maybe a country up to, talking if maybe they weren't open to that before. What this can do is it allows both countries to, essentially use their own strengths in the form of trading with another country, which is the goal of trade to begin with, as opposed to just, putting that tax on the other country that is not beneficial, both financially nor, using the labor and the skills that other country might have. So essentially what we're doing is we're maximizing both countries' respective strengths and then minimizing those weaknesses. So some cases in point for that might be, manufacturing costs. So if there's a very innovative company or corporation in one country, they might go ahead and use their abilities to manufacture a certain product very inexpensively. Maybe they have really good automation procedures or good technology to produce that, maybe less than another country, versus the country that they are looking to implement a trade deal with has lower labor costs. And they can use those to really work together and find a good way to manufacture a product that has the best of both worlds. So even though there might be some tariffs involved on both ends, depending on the size and the scale of the strength of one country or another, they still would come out with a better product that allows the U.S. or the end consumer to pay less overall. So really, a trade deal or a trade agreement is the Goldilocks scenario, so to speak, and allows countries to really utilize both of those countries' strengths to the best of their abilities. So we'll go ahead and do an example on that. Again, I cited the US EU trade agreement here. That was just last month. So some of the critical elements of this, so depending on where a certain product was made between the US and the EU, the US is not charging tariffs on critical items like aircraft parts, certain pharmaceuticals, semiconductor equipments, raw materials. I believe there was actually a few more on that as well. So it again carves those out. So maybe those items are very beneficial to the U.S. and we want to keep those relations good. So it might be just kind of a sweetener to the deal, so to speak. I can't speak for the administration on that, but that can sometimes happen. Again, this was mutually negotiated, so there are, those talks and that communication that happens as opposed to a, blanket stamp on that just says no, we're going to charge you for this. But it was signed by both the U.S. and the EU, so it's a mutually beneficial agreement on that. And then there was obviously the investment, the energy commitment. So this is really a way to allow continuation or a sustainable plan when it comes to a trade deal. So if one country is investing quite a bit of infrastructure or investment in one country, that's typically going to be a long-term deal if that's happening. So they're going to have to send assets. You know, labor, other types of equipment, maybe to the U.S. soil, and then buying that energy from us as well by 2028. So multi factors to this. Again, we're looking for ways to make that mutually beneficial, not just putting that tax on. And these are very economically friendly as well. We're not going to see those huge swings, mostly to the downside, but also to the upside when it comes to the markets. So, these types of headlines generally much more favorable when it comes to your stock portfolio and seeing the ups and downs than the Liberation Day was. So, I know we all saw some red on for a couple of those weeks, and it's never easy to see the portfolio values decline. So this is really a better option than just announcing a flat tariff in one country or multiple countries. So just as a summary here in the bottom, some of the features of a trade deal, for they're agreed on by both parties. They have predictable terms, predictable, just overall, outlines of those trade deals. It's more intentional, it's more stable because it's a mutual policy. U.S. exports get access to the EU markets while attracting, the EU investment here. So, we can, use those exclusively when it comes to investing in some of those markets. Again, we're leveraging strengths. So maybe there's a few things that, the EU can only get from us and vice versa. So we're going to leverage those strengths to make sure that those are being used appropriately between us. Just stronger supply chains. Anytime you have if you are a retailer and you have a direct contact with someone at one company that you use quite frequently for your, your company or your products, anytime you can go to that company directly and get that product from them, it's better than just having to go to the open market and shop for it. So that's really what we're trying to do is make sure that we can get some of those products, um, and incentivize, those long-term investments. All right, just one or two more kind of stats here, and then we're going to go into just some practical items. So again, just to kind of reiterate what you are feeling, if you felt the pinch when it comes to getting just your overall household goods or groceries, the working middle to lower class is really who is getting hit the hardest on these. It's really a cost anywhere from two to we'll just say 4,000 per year the average household. So again, average is kind of a kind of a relative term, but when it comes to kind of the overall swath of the population, generally kind of that middle to lower class areas where you're seeing this really get affected. Another component of the U.S. population being affected are business owners. Just in general, those higher costs of goods lead to higher prices for consumers, and business owners don't like charging more, just like consumers don't like paying more. So it's not a an optimal scenario, but again, it is kind of the way that things are right now. So business owners having to navigate that, the dilemma of raising the price of their goods versus maybe losing that customer. It's putting them in that situation also. And then also, retirees on fixed incomes, seeing those costs go up faster than maybe the your Social Security payments, cost of living adjustments are, or your annuities, or maybe your pensions. Those are all, items that generally tend to be more slow moving in terms of inflation adjustments versus, maybe we're just seeing here some of these tariffs go into effect by the middle of the year. Generally Social Security adjustments don't take effect till the first part of the next year. So, we're seeing that incongruency there with not having those expenses match up with the income. All right, so we'll just take a quick pause here and just check for any questions that have came in. Currently don't see any here at the moment, so hopefully we are at least comprehending most of this here. So our um, our attention level is still there. So I was worried maybe we wouldn't have quite the attendance or maybe the engagement when we start talking about cost of living adjustments and consumer index. So thank you all for staying engaged. As far as what we can do about it, this is really the point of this webinar today, and maybe why you signed up, which is to take those actions. Anytime someone feels that they can take an action towards improving something, that just gives you more confidence. And really, what we're trying to do here is promote that confidence in you to not feel as a victim to some of these things as you might feel like sometimes, but there are ways that we can fight back. So we'll touch on some of these here, and you may be already doing some of them. I'll warn that some of them are somewhat boring, and maybe they don't really have that wow and awe factor that maybe you're expecting, or unfortunately, the lottery is not a guaranteed system, and that's not what we're going after here. But we can put some authority back in our own hands here. So. As far as kind of some of these steps, we will talk heavily into budgeting and costs, but hopefully this will give you some examples that you can use to act on. So first thing, optimize your budget. Good old B word here. We all love that, myself included. Um, so optimizing your budget, optimize such a relative term sometimes. But really, it's just finding ways that that overall household budget can improve, right? So we're looking for ways to improve, not necessarily get perfect, but just improve. So tracking spending. You probably heard this from your mom or your dad when you're a teenager. Going out and just buying things without knowing how much you're spending or where you're spending it on is a recipe just for irresponsibleness. So, using a somewhat of a tool to go ahead and just track that, monitor those things. You may be doing a good job right now, but until you actually track that, it's hard to say, to compare that. So, technology is very, very useful in these areas. Tools like Monarch, YNAB. If you're into spreadsheets, using Excel, monitoring where your money goes, really any of those online tools like Monarch or YNAB can actually connect right into your credit cards, your bank accounts, and track all those expenses for you. So you're able to bring those in automatically in real time and track it down to really the day, see where you're at for the month. You can categorize things, really makes it much more efficient to monitor those things. So that's your baseline. That gives you kind of where you're going to start. Next, just identifying things that maybe you can get some quick wins. So inflation impacted categories. Again, we talked about these. Those are those hard items, those hard goods, groceries, household goods, transportation. Um, maybe going back a year before this and seeing, what you're paying for, let's just say a loaf of bread. We won't use eggs, because those obviously are a different story right now, but things like bread or milk, maybe some things that are going to be part of your household budget going forward, tracking maybe some of those pricing trends and finding ways to maybe substitute that, or if you find waste in certain areas, maybe cutting back and buying less. Those are all, kind of those ways to really open up the budget. Reallocating towards those essential items. So, if you're finding yourself maybe discretionary spending or, again, just gravitating towards those things, getting the list together before you go to the store or, um, maybe even, once you stick to your budget for a month, give yourself a time frame, and then at the end of that time frame, go ahead and reward yourself at that time frame, as opposed to, thinking that you might need something now, just delaying that gratification. Sometimes psychological changes help out with the overall budgeting process. Reviewing subscriptions. Subscriptions are a huge, uh, well, I'll just say revenue generator for the companies that offer them, but a huge revenue pinch for those that don't cancel those subscriptions and maybe pay for something that you're not using. So that's the quintessential way that we can make our budget be short, is to pay for something that we don't need. So reviewing those subscriptions, might be a gym membership, might be just a streaming service, might be something that you could share with someone else. So all those items can help that budget out. All right. Again, next option, researching lower cost options. So again, maybe something your parents or your grandma might give you advice wise. Maybe they told you they were gonna, buy you a product. You thought you were getting Legos and you got the off-brand. Well, it was probably cheaper. So there's a reason for those things. Generic brands can a lot of times have that similar quality, and they're offered at many stores, but you just got to look out for them. Some obvious examples here. So, for the Costcoers out there, love the Kirkland stuff. At Best Buy, I worked there in college for a while, and we had several different brands. As an employee, we got those way cheaper because our cost was cheaper. So Rocket Fish was one of those. Cables and accessories and those types of things, were typically kind of your house brands. Members Mark, if you go to Sam's Club, obviously Amazon Basics. Those are, multiple different ways you can find those products. Name brand companies will frequently go ahead and make those and sell those. So you can find those for typically much cheaper than the name brands. So comparing prices across retailers, again, just a wonderful technology service that we have these days. I believe Capital One also has this, but basically a browser extension to essentially monitor those products that you're looking for, and then go ahead and automatically compare it for you. So, I will say they are a bit annoying sometimes if you literally just want to go maybe map out a trip across the state that you're going to take next month, and you get inundated with, buy this from here instead. it can still save you some money. So even if it's annoying, some of those services can help you to find those products for cheaper. Store apps as well. Bulk. If you do buy in bulk or like to buy in larger quantities. Store apps might give you a $5 off or 10% off over a certain amount. Make sure you're utilizing those. Sign up for the rewards programs as well. One other thing here, I like to do personally, I didn't put in here is, whenever you go to check out, for instance, if you buy online, just search, quote unquote website, online coupon. And a lot of times that will give you a code or something that you can use to type in. And it may be 5% off, 10% off, but might cover your shipping costs. But it's always worth it. It takes, just a couple seconds and always worth trying to see if there's other, coupons out there that you might be able to use for those online sites. Use refurbished items. Definitely a lot of use cases for refurbished. There are some things that I would say probably aren't good refurbished, but there can be things, tools, generally don't go down in terms of use, and can be seemingly cheaper secondhand. Finding those, old school garage sailing can work. Those thrift stores, maybe those nonprofit companies, great way to start. So again, might take a little bit more time, might take a little more energy, but can definitely find ways to save the money on those with just as good of products. Community exchanges, Facebook Marketplace, local swap networks, those items really, and I found that if you look for something, those will generally pop up in your feed later on. So the social media knows what you want, whether you like it to or not. All right, moving on here. This is where we're going to go into a little bit more on the deeper financial front and ways that you can use your money to work for you more outside of just your budget. So, tax savings opportunities. If you've been on any of our webinars before, generally tax is a theme that we try to incorporate with a lot of our webinars. So some of the things that we're seeing here are as applies to our investments, our investment accounts. One is Roth conversions. So if you're not familiar with the Roth conversion, basically we're taking money from a pre-tax traditional or SEP or simple IRA, moving that over to a Roth IRA. What that does is that moves that money from a pre-tax account into a post-tax account. When it comes to growth, you do pay tax on it at the time of conversion. So this is a somewhat longer term solution to allow you to experience tax-free growth down the road. And there are some times when we can take advantage of this. One is when markets are down. So that's when we want to take advantage of low investment prices. So, if you were to time it perfectly and you knew exactly how to time the market, back in April was a great time to do a Roth conversion. After Liberation Day, just because we saw those markets really have that snap down lower. If you did that, please call me. I'd love to know how you did it. That will allow you to basically, convert that money when that asset is low priced. And then essentially then at that point, you've gone ahead and you've moved it from that pre-tax account over to that post-tax account. When that rebound happens, anything from the point that you purchased at inside of that post-tax account going forward is now going to be tax-free. So you've essentially locked in your tax base. Now everything above that is gravy, and you're appreciating tax-free at that point. Another time is when income is low. If you can do these both, that's great. Or just one is still good. But when your income is low, then we are not only we are taking advantage of a low tax rate when it comes to reporting that conversion on your taxes. So that allows more income to be reported on your tax return at a lower rate. So you're taking advantage of, when your tax rate is going to be low, as opposed to guessing maybe down the road what your tax rate is going to be. So you are trying to make an educated timing decision on when to do that. So again, if you can do Roth conversion when markets are down or when income is low, that's good. If you can do them both, that's even better. So just one case there. Um, Bunching deductions. This is another opportunity we can discuss here just briefly. But basically, it is a form of charitable deduction that you're getting if you do give charitably, whether that's to a nonprofit, to a church, charity, whatever that may look like. But essentially, we are timing our contributions in a year that we know our income is going to be higher, or where maybe we think that maybe the tax policy will be less favorable down the road. Again, we're making an educated decision to go ahead and pay a lower tax rate now that we know, as opposed to guessing on what that might be down the road. If you'd like to dive into this in more detail, we do have a webinar on tax efficient strategies for charitable giving. If you go to our website and click on past webinars, you'll be able to find that webinar there as well. All right, a few more on tax savings. Business owners, if you're self-employed, make sure you're tracking all of your mileage, your expenses, food, entertainment, all those things. Those are great ways to write off those expenses against your income. And then also just maximizing those retirement plan contributions. If you aren't familiar with small business plans or have not set up a plan for your small business, if you contribute to a 401k, or if you have a small business and you've not set up a 401k, or maybe a SEP IRA or simple IRA, those are ways to offset some of that income with higher contribution limits than just a traditional IRA. Um, Another case in point here is actually an HSA. So HSAs do require that you have a high deductible health plan. However, if you do have that option, that can be very valuable. HSAs do offer triple tax-free advantages, so they are one of the few places that you can get three types of tax savings. Example here is a couple that is in the 22% tax bracket, increase their HSA and 401k contributions, offsetting their income by the amount that you put into those, saving nearly $3,000 in taxes. And then, yeah, another thing is just reducing their adjusted gross income, which can qualify you for other tax credits, other types of programs, if you bring that down below some thresholds. So, very different strategies you can use to help offset your income. Again, you're not a victim in some of these cases. You do have strategies at your disposal if you use them correctly. Right. I think this is our last one here on this. Thank you all for continuing to be patient as we go through some of these. Not exactly our most exciting topics, but hopefully these are valuable to you here. As far as investment tax allocation. So, what do we mean by investment tax allocation? Well, really, we like to use the analogy of a sports team. So I'm a baseball fan, and with baseball, you have individual positions and then you have position players. And for position players, for instance, your outfielders are going to have different skills than your catcher will. And what you're doing is you're really putting those best performing position players in the positions that they're most comfortable with and best performing in those positions. That way, they maximize what they are capable of doing. So it's exactly like that when we come to our investment tax allocation. So what we want to do is we want to put the best types of investments in the best types of positions. So by positions, we mean the three different types of accounts. So the three different types of accounts are going to be your taxable accounts, things like individual joint accounts, trusts. You have your tax advantaged accounts. Those are things like traditional IRAs, 401ks, SEP IRAs. And you have your after tax accounts, which are going to be things like your Roth IRAs, your 529 plans, and then also HSAs. So, how you can do this is if you keep your income producing investments, those are things like your bonds or real estate investment trusts, maybe, we'll just say things like dividend paying stocks that maybe are we'll just say kind of some of the blue chip stocks. We'll just say, for instance, Johnson and Johnson, just as an example. You're keeping those investments in your non-IRAs, and then your growth investments are going to the ones that are going to be your highest growth investments are going to be in your tax-free accounts. As far as tax loss harvesting, these are ways you can offset capital gains really by selling assets that are at a loss. So this happens in non-IRA accounts So things like, again, your individual joint accounts, revocable trusts. Really, what we're doing is we're purposely taking a loss, and then we're buying back into an investment that allows us to take advantage of the performance of that asset, yet booking a loss on paper that we can use to offset those gains on our taxes. So, if you haven't done this before, definitely proceed with caution. Any advisor that you work with should be able to do this for you. If you're not getting that currently, please talk to us and we can help you with that. Capital gains timing, short versus long-term capital gains, just knowing the difference between those two when it comes to realizing those capital gains. Again, if you have a large sale in one year, that will increase your overall income and overall taxes. You can time those capital gains in years where you are going to pay less in taxes. And really, that's the point, is to go ahead and pay less overall in taxes and pay taxes when your rates are lowest. Municipal bonds can be a great way if you are looking for income, or maybe you're not in a growth phase anymore. Maybe you're in distribution phase, you've retired, you're drawing income on a lump sum. Those can provide tax-free income. Municipal bonds can be federal and possibly state tax-free, depending on which state you live in, and also the type of municipal bond you buy. Just kind of a little visual here that we put together. This is looking at the tax location again of those asset classes. So we have our different classes here, these different buckets, and then the associated timeframes with those. So immediate here, really we can talk about this as really our cash in the bank. Not really anything fancy with this here, just kind of this emergency fund. Then we get into short, medium, and long term. So again, we have those non-retirement accounts, revocable living trusts. Those are going to be your, kind of lowest performing, so to speak, asset classes, but giving you the most stability. And then on the long term here, we have the highest growth assets. Again, so we have your less aggressive accounts down here, and then your more aggressive accounts here on that right side of the table. And hopefully you see the long term, these buckets here grow. It's not just a perspective visual, but hopefully you do see that these assets here grow, not just on the chart, but hopefully this bucket is the biggest for you. So that was intentional as well. One example is, so if we look at a pre-retiree, maybe someone who's at their peak earning years, maybe mid 50s, late 50s, somewhere in there, have a high income amount. There's also an income surcharge for incomes over 250,000, to where they shifted some of those higher yielding assets, or the ones that are producing more on their tax bill, to by reallocating their investments, and really essentially doing this right here. So making sure that the lowest impactful tax investments, or lowest impact to tax investments, are going to be in those short-term buckets, while we have those highest growth yielding assets in those long-term buckets, to where you're not paying tax as you go. It's actually tax-free on that growth going forward. So simple changes like that. If your advisor is not doing this for you currently, they should be, and this should be part of the overall retirement plan or financial plan that they're getting for you. This is something that we do with all of our accounts here, and it is significant in terms of the savings that can result from that. All right, just take another pause here real quick. Hopefully, our brains are doing okay here. Please feel free to comment, chat if there's anything that you'd like us to discuss or cover. Not seeing anything right now, so hopefully we're still all on the same page. That's the case. We'll keep on going here, and maybe we'll end a little bit early. So wanted to just go over outlook here going forward. So again, this is not a doom and gloom type of a webinar. We're just kind of setting the stage and allowing the data to speak for itself, and then also some of those practical things that we can do to go ahead and mitigate the tax bill or your tax situation. So as far as outlook going forward, first thing is there could be legal challenges to some of these these broad sweeping tariffs. So unfortunately, we do still have a pretty divided Congress right now, even though there is a slight majority for the Republicans. It is still something that can shift depending on the news or how it impacts certain hot button topics. With the recent One Big Beautiful Bill that came out, there's definitely some recent feelings towards that, some sentiment, so that can spark those legal challenges or those legal appeals for that. So we'll see how that goes. Definitely nothing is set in stone. The Fed is still cautious with rates. We did see them still maintain their rates in terms of their funds rate. So obviously we see Trump, wanting to drop that, but it's definitely still in the end it is up to the Federal Reserve to manage that policy. So that might not still change here for quite some time. So things are more probable that there might be a rate cut in September, but again, there's no guarantee with that. And the good thing is there are new trade talks underway, still continuing to develop there in terms of our trade agreements and those agreements that we think will be helpful. So it's good to see continued headway in those areas. Final takeaways. So, just as a recap or summary, so tariffs are that hidden tax, really with largest impact on those lower to middle income households. So nothing we can do about that, just kind of a fact of where we're at. Not necessarily all those tariffs that are implemented get passed on to us, but we do still continue to see that impact. Um, so we do see obviously that tariffs can raise those prices and inflation in the short term, but it can lead to a catalyst to those long-term beneficial trade deals to where we are seeing that investment come back here to our home country and lead to more sustainable longer term manufacturing costs, less reliance on foreign manufacturing, allows us to withstand major economic turmoil or potential wars by having that stability here in the U.S. So trade deals are definitely a huge benefit of a potential tariff or what starts out as a tariff that ends up with a trade deal. And then obviously on the personal front, doing something about it, proactive and intentional planning is absolutely the best way to, keep your hands busy and not dwell on the negative, so to speak. Looking at ways to really help the final budget, as they say, the bottom line. So really we can control those costs that we have, control over on the micro level here. So even if we're not able to, have a say in the global trade policy, we can still manage our own personal budgets and households properly. So, all right. That being said, my rant here is mostly over, and I appreciate everyone, all of your engagement and being involved in us here. We're going to look at questions here now. I have a couple come in, it looks like. So perfect. Let's go ahead and cover those. All right. Let's see the first one. So why did the markets drop so much in April when Trump announced the first round of tariffs? So if anyone's not aware, Liberation Day happened in early April. So that's when we saw that kind of list of tariffs that came out. So really it was an anticipation of a worst case scenario. So we do know that markets are forward looking. They're kind of the emotional temperature gauge, so to speak, of where people are and what's going to happen. If you've ever maybe ran into someone that anticipates the worst case scenario, that personality is basically what the markets were looking at. So if the worst case scenario happens, there's huge tariffs on all of our trade partners that it was multiplied across hundreds of different countries. We're seeing that play out. There's tariff wars. Now we're paying more in tariffs to them to export our goods over. And, it just escalates out of control. Whatever that may look like. The markets were just anticipating the worst. One thing that markets also look at is future earnings. So if we do see higher tariffs, that means that generally earnings are lower, with no other, with all other things being constant. Earnings might be lower, which would cause, less value in terms of investments. Um, so the case in point, or the short answer would be that the markets were anticipating the worst case scenario, and we saw that that wasn't the case when we put on the 90-day pause, and then people kind of had this chance to reset and breathe. And then we saw those markets really rebound after that. All right. So two other questions here. We'll actually answer these at the same time. They're somewhat related. So first one is, where should I invest my money when there is high inflation? And then second, is gold a good investment when inflation is high? So great questions. Definitely relating to investments and putting the money to work for you smartly. So investing your money when there's high inflation generally just is going to come back to prudent investing principles. We believe in diversification. There's not really a time to necessarily get out of the market. There can be more favorable investments during times when, there's high inflation where we might go ahead and shift assets to other areas. Right now, with our portfolios, we do actually have a heavier concentration in real estate. And what are called value companies, which generally are lower valued compared to where the market thinks that they should be. And so those types of stocks or investments generally will perform better. And then, is gold a good investment right now? The short answer is yes, but for who knows how long. And so gold is also a good investment when inflation is high, until it's not. And I think that's the biggest example of it is, we've seen actually gold be on a very, very good run, probably one of its best runs ever here over the last year and a half, 2 years, as we came off of high inflation with COVID and going into, maybe the tariff situation. However, gold historically has not actually held its value as compared to the returns that you get in a diversified growth portfolio or balanced portfolio. It simply just goes in and out of favor without prediction. And so we don't put a ton in gold. We do invest a little bit in gold, but we don't believe that it's a long-term solution just because the history has proven that other types of assets will outperform gold on the long term. But by and large, we just prescribe to very disciplined investing principles, consisting of disciplined rebalancing, making sure that you are diversified across multiple areas, geographies, sectors, and industries. And the hard part is timing when to get out of gold. So if you know exactly when that's going to happen, great. Would love to talk to you. But in most cases, timing that exit out of that investment is the hardest and arguably the biggest risk. I'm not seeing any other questions come in. If you do have anything, please go ahead and type those in now. Um, We'll just go ahead and go to our next slide here. And if anything comes in between now and then, we'll go ahead and address that. Thank you all for your time, your attention. Hopefully this was beneficial, valuable to you. If you do want to get in touch with us and you don't currently work with anyone that's helping you navigate some of these headlines or some of these situations or decisions that you're running into, please go ahead and get in touch with us. We'd love to meet with you, find out really what's on your mind, find out how we can help you, make sense of all these things and come up with a plan to get your future on the right track, help your family, help your retirement, help your tax situation. We'd love to be of service if we can. So I don't see any other questions come in, so we'll go ahead and end for now. Have a wonderful evening. Thank you again for joining. We hope to talk to you soon, and make sure to join us for our next quarterly webinar coming up in quarter four. Have a great evening. Thank you.